watching Master Trader Live. Simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Good afternoon, everybody. Wednesday, Master Trader Live. Candlesticks, one of the most talked about things that people just love to hear about, all about the price action and watching the candles and why. Well, this is what tells us when to buy and what to sell. It's not quite that simple because you have to combine a few things with candles. And Dan and mine always objective in teaching what we do is simplicity. So one of the things that we always say is, who cares about what you call it, the names? It's about the message. And by understanding multiple time frames, you begin to learn that the message with different pictures, right? It's pictures that we look at, that different pictures can mean the same thing. So many years when I started out, and I got caught up in part some names and thinking that this particular picture was what was required to make money. And so I had to have that picture. Makes sense, because as you start to learn, it just seems to be common sense, but there's a deeper understanding of it. And part of that is about retracements, and that as you start to look at these candles, that looking at different time frames, too many time frames can actually become a detriment to your success. So we'll talk a little bit about that and how to simplify, because you look at too many time frames, it becomes analysis paralysis. But so let's get into it, Dan. Let's simplify things and bring clarity to what we do, and help everybody understand the markets and make money.
Awesome, let's do it.
Yeah.
Yeah, one of our best patterns, and I've read so many trading books, and I've started with classical technical analysis, Steve Nissan's on Japanese candlesticks, encyclopedia of chart patterns, all that stuff in the past, and chart patterns, are different. That's what we're going to show you and what we teach. But today, what we'd like to do is, as Greg said, show you the messages of every single bar. And then trading is all about, oh, did you hear me?
Yeah.
Okay, my Yeti was off, blinking. All right. So it's to read the messages and not get hung up on the terms. And yes, we have some terms for ours just to speed the process of communication of what we see. But, so many people misapply. They say, oh, bottoming tail. So that's a bullish reversal. I got an email yesterday on Snap, bottoming tail, but it was after a climactic buy setup. So it meant nothing. So again, that's what we're going to do today. Go over the messages of these. This is a slide our viewers have seen before, and you're going to
not everyone, Dan.
That these are the concepts that we put together in determining the probability of the quality of a trade setup. And so everything starts with a compelling price pattern, the trend, multiple time frames, relative strength or weakness. We're going to cover a lot of this today, the messages of each bars. RBI means red bar ignored, green bar ignored, bottoming tail, topping tail, range expansion bar, engulfing bars. You're going to see those with many examples, but with a proper interpretation instead of just looking up your old textbook and saying, oh, it's this name, so it's this meaning, which could be just 100% misplaced. We're always looking at the market bias and market internals, and then you just enter and manage. Greg, why don't you talk to them about the way candles speak to you? You have so many incredible sayings. It is.
Right. So look, visually, when we look at a picture, it speaks to us.
Right.
As day traders, investors that are using technical analysis, we look at charts and their pictures, and they can tell us what to do, or they could lead us down the rabbit hole, a black hole, if you don't know how to read it. So kind of like speaking to someone that speaks a foreign language when you're starting out, so you can misinterpret the message. So we have to have structure. We have to bring structure to the markets, and the markets can move in a vast amount of ways. So we have to bring it to the way we need to see it for the time frame we're trading in. So as we look at these individual candlesticks, we take this brick, let's just say, to make an analogy, and this brick, and we put it all together, and now we have a foundation. And then we can start to build, to go higher. So as we take this individual candles and put them together into this message, like this chart that we're looking at over here, it begins to speak to us. So when you hear Dan and I'll say, oh, there's a breakdown failure, or there's a red bar ignored, or a green bar ignored, there are other concepts that come into the analysis as to, well, did that happen in an uptrend, a downtrend, a sideways trend? And the first slide that Dan showed spoke about multiple time frames as well. So all of that comes together that puts the odds in our favor. So for example, on this particular chart where you can see that prices go vertically to the upside, and then there's a small candle body, the little green part at the top there. That's the difference between the open and the close versus the candle that preceded it where it was big. It was a big difference. No, Dan, go back.
Well, I'm just helping.
I'm talking about this one. And I can point to it, make it a little easier. So I'm, that, 1 second here. So that's the big candle, and that's the little candle right there, the little candle body. So as that momentum slows down, one of the things we need to look at is, well, where is that happening within the location of what's to the left? Is that at resistance? So again, these candles tell me that big candle, because it started here, that big candle started the move, whereas this big candle is telling me it's near its end. So it hasn't reached the destination, meaning what's to the left. And then that next candle becomes smaller in range and the momentum is slowing, it speaks to me again. And so it's in a continuous conversation between us and what the chart is telling us. So let's continue.
So these, you can, in books, they like to tell you about all these fancy names, and then they give you a definition of what it means, a gravestone doji, all these scary names, Tosuki gap, hanging man, and you don't need to memorize those. Again, we're going to show you how to just look at the bars and the pictures objectively and the messages. This is just a very simple definition of a candlestick. It applies to anything that you can trade on any time frame. So whatever time frame this is the real body, the difference between the open and the close. And then you have the high of the bar and the low of the bar. So the reason the bulls win in this candle, and they win decisively, because it opened up here and demand just aggressively brought it higher to close near the high of the bar. Bulls win that one. Bears win this one. It opened up here, closed here. That's just definitions, but again, we have to look at the overall pattern. These are all different pictures of momentum slowing. On the other chart, Greg mentioned this wide range bar, and there's different flavors of slowing momentum. Topping, and also visualize what is going on in a tail within the bar being created. So at the very high point of this bar, this was a thick bar like this, a big real body. But the bar wasn't done being completed, and the bears made it close all the way back down here. Hence, slowing momentum. These are all different flavors of slowing momentum.
So Dan, when that happens, as we talked about red bars being ignored and green bars, and of course bottoming tails can be ignored and topping tails can be ignored. So one of the things that I wanted to know when starting out, because we all want to know these things, because the more we know, the more we understand, the greater the probability of making the right decision. And say, well, why did that topping tail form? Right there. Why did that happen?
Supply was increasing.
More sellers. Right. So when I see that, and part of when we look at this and we say, well, how does that possibly get ignored? How can I ignore it if it, or assume that it could be ignored?
Well, because of the overall bigger bullish picture, demand buyers are still coming up to buy retracements.
Right. So if this move began out of a consolidation, the start of a move, sometimes I see a topping tail. And when I see that, many years ago, it would scare the hell out of me. And I'd sell. And then I'd see it going back up. And so part of what we're doing, we have to realize where these candles form in relation to a trend, and Dan said the bigger picture, and that's how they could be ignored. So we'll look at some charts to reinforce that. But also you have to realize that there are people trading in smaller time frames that, like someone on a 1 minute chart or a 2 minute chart, where maybe you could be on a 15-minute chart. Like Dan uses that a lot. To them, it's looking like a giant move. And in reality, from a bigger point of view, bigger time frame, it's not really meaningful, but they're giving up their shares only to see things continue.
So kind of covered this already, and you'll see these just jump out. All these candles that we're reviewing, when you'll see them on charts, they jump out at you. What is a wide range bar? Well, it's one that jumps out at you relative to the size of a regular bar. That's that simple. And it can be, a wide bar, the range, and then a wide real body is more powerful. I already mentioned to you on the other slide about picture what this was at the very high. It was a big green bar, and sellers slammed it all the way back down, not only below the opening price, but below it. So the message of that is sellers are taking control. But just like Greg said in the prior slide, okay, they took control in that one bar, but what's the overall pattern telling us? We talked a little bit about momentum slowing and being ignited. So this is just a nice little stick figure showing you how these reversals can happen over time and in different pictures. And, we're just saying least potent to most potent. Why is that? Well, this one's the least potent right here. One red bar in a power move doesn't change that uptrend. Could it retrace? Could it go sideways? Sure, but that's not a potent reversal. Potent, powerful, reliable. This one's more potent because it gapped up and got slammed back down. This one, topping tail. This one, big bearish engulfing. This one, just a combination of those two. But you have two bars of selling instead of just one. We'll see plenty of pictures of this.
So Dan, maybe for a moment, one of the concepts that we discuss in MT Live, and those of you that are new, this is what MT Live is about, is to take a particular subject and speak about on that subject to teach you about it. But one of the things that we could add to this, without getting too deeply into it, is that all of these pictures are about psychology as well, as to what did this mean to the people that were trading it. Whereas as this is going up and up and up, traders are getting more excited about the gains that they could be making and trying to jump on board. So a little red candle, and then this one here isn't that meaningful as far as just a stall in the momentum. Whereas if we look at this one, it gapped up and came back in. This one traded higher and then traded back down below. This one gapped up and then came all the way back down, and so on, and back down again. So as the range expands and then it retraces all the way back down again, it becomes clearer to more traders or investors on a higher time frame that something wrong happened versus just the slowing in momentum. So the bigger the candles are and the bigger the reversal between those candles, the more powerful they are.
These are all very bullish, little simple candlesticks here. It can be of anything. And so these are the names that we give them, as we say, just to speed up the process. A buy setup in an uptrend. Here's a red bar ignored. Breakdown failure or a downside shakeout. This red bar broke down, snapped right back. So like on the prior slide, this is what we call a potent reversal. We love these shakeouts. This 180 reversal is a potent reversal. The 3-bar reversal, a gap. We love trading gaps as a shock pattern. Failed sell setup, similar to red bar ignored, and W bottoms, 1, 2, 3 continuations. These are all compelling setups, and then it's our job just to put them in connection with the multiple time frames, the trend, support and resistance, market internals, and that's what Greg calls our factory work. Every single day, we're just applying the master trader concepts to what it is, the markets. What are we looking at?
And let me answer what's his question here. That he's asking, do you just look at a 5-minute for entry exit and a 15-minute for a bias? It's a choice. So one of the thoughts or questions we all have, like was asked before, what is time frame to use? And it's a choice. There's really no right or wrong. But you have to realize that the smaller the time frame you go down to, the more information that you're processing. So the slide that Dan is showing, all of these things, or a combination of them, you're going to see a whole lot more of them. And there's an advantage and a disadvantage to that. So as you interpret these candles, and you get sometimes conflicting messages, that tells you that you're into a mess in that time frame, so to speak. Whereas on a higher time frame, you don't see that. And so because you don't see it, it doesn't bother you because it doesn't create any thoughts about it. Whereas, okay, so if you're just looking at a 15-minute or an hourly chart and you just see a solid green bar, there's nothing wrong with it. Whereas if you're looking at a 2-minute chart, all of a sudden there's this big giant retracement. And so from your time frame, if your money management is based on that, maybe you're selling, whereas someone on a higher time frame doesn't see it. So you have to decide what's right and wrong for you. For some people, going to a 2-minute time frame is a sure detriment to their financial well-being, especially if they're starting out. Whereas if they were using a 15-minute time frame or a 30-minute time frame, not processing and seeing all of these different candles, they would be able to do well because things are slower. Sometimes they relate it to, when you're starting out, should you be driving a Formula One race car, a 2-minute chart, or should you maybe be driving, a Honda and learning how to go fast around the turn, so to speak? So it's not a right or wrong, but when you're starting out using a higher time frame, you have more time to decide what to do. So
we'll be pointing these out, but shock patterns, shock bars, and then shock patterns, the gaps, failed breakouts, breakdowns, M&Ws, and the red bar ignored. Again, that does not mean you trade those. It just means that's more information, which makes a setup more compelling for us. These are all pictures and everything we're covering today. When you see these charts, when we get a compelling pattern, we can either trade stocks or options on, and provided the options are liquid. But there's many patterns where we just say, well, I'm not going to buy that issue, but it sure looks like a convincing short-term buy. That's when we love selling options around them and credit spreads. So all of these pictures right here are candidates for bull put credit spreads. We sell an out of the money put under support, buy a further out of the money put to make it a spread. And that difference is the money that goes deposited into our brokerage account. And as long as this holds support into expiration, that money is yours to keep. So we love these setups. Just since we were talking about potent reversals, the bottom left here is the beautiful W bottom. Here's a 180 reversal. Here's a downside shakeout. Here's a turn that's occurring over 3 bars. There's a little, gap reversal. These are all great patterns. Now we'll just start looking at charts. Every single one of these stars, we could have done bullish stock or option trades, but now let's talk about the overall patterns with the background of the information of the bars that we just went over. This one is a bullish gap. It was starting to roll over here, but it held on support, and that's what we call a bullish pro gap. We could have sold out of the money puts, maybe 30-minute high, a bullish stock or option trade, and then the uptrend continued. This, Greg knows, this would be a salivating pattern for us to sell an out of the money bear call credit spread. So just visualize this in connection with the slide we talked about, least potent to potent. So Greg, why is that a beautiful potent reversal?
Because it's a shock, it's a trap. It's the unexpected, it's beautiful. And that it gapped that 3-bar consolidation prior to it, right there with the bottoming tail bar, and then it doesn't break out. Well, it gaps above, and then it gets sold into. So traders are caught, and not only caught, the ones that bought the gap up. And let me clear this so you can see it a little easier. So the gap up was right about there, and then it went higher, which I know that pattern tells me that intraday traders bought a little breakout on, say, a 2-minute chart.
Right.
and it should have went higher, but it didn't. And they got caught. And then as it deteriorated, it went through what should have been support right there. And it kept going down. So Dan, you often asking me, what's the odds of that going above that price in the next 3 days? And I'm going to say 100%. And you're going to say, no, you shouldn't talk that way. But that's what I would believe if I saw that. It's just impossible it's going to, get over that in the next few days. And that's the kind of credit spread that we like the best, short term. But anyway, that kind of a shock communicates to me that so many got caught with the unexpected. And some of you that are new might be thinking, well, how would you know that that's going to happen? And I'll tell you, I don't. Nobody does. But the point is, there's a little extended in the short term. So maybe there was a clue of it.
Right. I was going to add that.
Yeah. But once it happened, it's done. And so that just brings in more sellers, because if you put yourself in the bar as if you were actually buying that trade, either on one of the 3 bars or the gap up, you're either losing money and you're going to want to cut your losses, or you're going to want to take your money and save what money is left that you're going to look at, well, what I could have had. And then those that don't sell, they don't even have a plan, or they rationalize, oh, it'll come back, it's in an uptrend, so on and so forth. That is where, this hope just traps traders. And, now they're down this much, and they see this begin to consolidate here, and think, oh, it should go up. Well, maybe it would have, and then it doesn't. And then, the big bar, and the whole process starts all over again.
And tell them what we would have done on this bear gap.
Well, I would have been shorting intraday, but then you get the
Absolutely.
1, 2, 3 to the
Absolutely.
downside.
Right.
So there's a wealth of information here. I mean, Dan, we could take, and we should do this one day,
Yeah.
is take one chart and then expand it into multiple time frames. And what you see when we say a 1, 2, 3, that's over here, that star, what happened intraday. I mean, that would be a little seminar in itself.
Sure. No,
Yeah.
I like it. And I should have put a star right over here. This is a buy setup with 2 bottoming tails after a pro gap, rally, retracement, closing above these 3 highs. That was a no-brainer entry right there. So this one we would have shorted the stock based on an intraday setup, and also sold out of the money call spreads. That's a bearish 1, 2, 3 continuation. Remember, momentum slowing, we've talked about a few times. The size of the bars. Now the range is contracting and it's not going down anymore. That's what we call, hey, Greg, remember Bill Knotts? He would always say, folks, that's what we call a clue.
Yeah.
So this is a clue that buyers are stepping up. It's building support. Here's a range expansion bar. See why we spent time on the definitions of how to interpret this? So range expansion from a base, going sideways 3 more bars, and then gapping up. That's a no-brainer long stock and option trades, and also selling an out-of-the-money put spread. It's kind of like a sloppy bull flag consolidation, but then gapping up from that, range expansion, consolidating at resistance. Looks great.
Yeah.
And yeah, we don't need to go over all the slides, but you'll see every slide, Greg and I, our eyes just pop out of things that we could talk about. And that's what Greg's seminar is about, the swing trading strategies, is putting all these concepts together. This is a breakdown failure. That red bar communicated lower prices. The very next day it gapped up and reversed it. Does that mean I buy? No, because there's a wall of resistance to the left. But it's just a message that, number one, if you're in the trade, should be, again, Bill's word, a clue to get out. But there's no setup until, I mean, even this would be aggressive because it's in a trading range mess. But this is another ugly reversal. The gap over the red bar, gapping out of this multi-month trading range. And notice that there's very little to no tail. What that means is the big gap up didn't go down when at the market open. So this would have been on our morning gap list. We look at gaps every single day in our green trading room during our pre-market prep. And this would be a tier 1 gap, as I call it. I'd put it in a little 5-minute thumbnail. And that looks like a candidate to buy a 5-minute high. Beautiful. Here's a bearish gap. So the gap might seem big, but look, the messages of all of these bars are saying what, Greg?
It can't go up. It's trying to hold there.
This was an upside shakeout. Everyone in these bars are now doing this, and it couldn't retrace. And what, folks, you answer this yourself. What is the message of that topping tail bar right there? The message is it was green at the high point of the day and got slammed right back down. Then it made lower lows, lower highs. This bottoming tail produced nothing. 3 more days of going nowhere. Look over here, the stock. This was some movie ticket company, HMNY, $1,100. Over here, it's a penny.
It's crazy.
So don't ever think your stock cannot go lower. It can go to zero.
So that little pattern there, Dan, where you showed the topping tail, where the sellers came in,
Right
trying
here.
to, yeah, trying to trade that, what could have been a nice bounce, and it
Right.
failed. And then it comes back down to the lows there, and point the little bottoming tail bar that doesn't produce any upside.
Right.
So this is how the candles speak to you, the candle language.
Right.
And so when it breaks the lows, you might say, well, how do I know that this breakdown isn't going to fail? Well, in reality, you don't, but the weight of the evidence is that it's going to go lower.
Overwhelming. Right.
Right. So we're odds players, and we look at these candles and put together what we've been talking about. Is, was it going up or down or sideways? What preceded it? What happened? Are traders caught? What's the psychology of the pattern? What are the traders believing, and so on? So all of these things, again, can talk to us, communicate to us on an ongoing basis for us to make our decisions.
Beautiful. This is what we call a bear gap that bullies pattern. And very simply, it's an ugly gap. So this is the daily on the left, 15-minute on the right. This suggested higher prices. Gap down to support, but it's an ugly gap. That gap gapping under all of this support suggested lower prices. Here's the 15-minute chart. With it, I call this pattern, it quickly negates a bearish gap. So as long as it does that within the first hour and you have a price void and a bullish intraday, these are wonderful patterns. But the message of the bar, it was a bearish gap ignored. This is a wide range igniting bar. Notice how this one negated the gap in less than 15 minutes of the market open. And then there's our afternoon breakout. Again, we're just reading the messages. So this was a nasty collapse, range expansion, green bars ignored, new low breakdown over lunch. This is 1 p.m. And it snapped right back. Then it consolidated until 1500. It's a 3 p.m. reversal period and broke out. So this is a big reverse heading shoulders, and those are the messages. This bullish consolidation, we call this because of the momentum move down. It has room to rise. A price void means look to the left and there's not significant resistance.
Like what we've had, the last couple of days where the market came down hard last week, and then, they stabilized and then turned up into the void.
When we folks, we'll be looking at real charts here in a few minutes, and that's exactly what we're in now. The daily charts are a lot of them just messy as can be, but there's been bullish 15-minute charts all over the place yesterday and today. The FANG stocks, I said this morning, they look like helium balloons, the 15-minute charts. So it's amazing.
Yeah, let's answer Terry's question for a second, Dan.
Sure.
Just go back to the other slide. Yeah, so Terry, after you have a few bars up, but it happened, it came out of a base. So the move just started. So you can't just buy after 3 bars up and assume it's going to keep going. You need some kind of a correction or a correction bar. And so what we are looking at here, let's see if I still have this. What we're looking at here is a type of correction bar. So it went down, it stalled, and it went right back up again. That slide that we showed, several slides ago with all the different candles, and it was a retracement. So in some time frame, that looks like a bottoming tail bar, right? The candlestick book would call that a morning star. I don't know. It doesn't really matter to me. It went down, it stopped, and it went back up again. So it could be a bottoming tail bar. It could look like that. Sometimes we call retracements a positive or a bullish 180, which means it was a red bar that went down and a green bar that went right back up again. So as you look at different time frames, you get different pictures, but those pictures have the same message. If you just know how to read them, that simple slide that was there, that's here's all these messages, and it said, I don't care what you call it, it's going up. And that's the message here. I don't care what you call it. It's going up. Why is it going up? Because of this, breakout and avoid. Where can you find information to trade options? At the Master Trader website.
Yeah, I just gave him the link to the seminars. All right. This is one actually we did yesterday. This is just, so the messages here, the daily chart, workhorse, all this volume, the messages are extreme greed, excitement, that people just keep chasing and chasing and chasing and chasing. And I tell folks, I said, as soon as the jet fuel runs out, this will come back to earth. So using multiple time frames, yesterday, here's our 180 reversal on the 15-minute chart. This was a bullish bar right there. That's a bullish bottoming tail, range expansion bar on support. But now let's apply the concepts that we've just been talking about for the last 30 minutes. Red bar, it should have gone higher, lower low, lower high, another green bar. As soon as it traded under this green bar, this is the alert that we sent to our swing and options trader service. So folks, check this out. The stock's at $18. We sold a July $30 call. So Greg, why don't you, because I love asking you these questions, based on this chart, this picture as of yesterday, today we've already covered half for $1 gain in one day. What do you think the odds of this picture on the left going to $30 in 2 weeks?
Unprobable, but I've seen those charts be scary, Dan. It's very improbable because it moved up as far as it did. It doesn't look like, I don't remember exactly, but remember our conversation with Tilray at 100?
Right. Right.
Right. So these stocks that have the rocket fuel, as you say, I mean, in 2 weeks, highly unlikely because it's so extended vertical move to the upside.
Right. So when we took our $1 gain, $1 of this $1.75 this morning, I moved the stop to the day's high to lock in a gain on the back half. Here's just a breakout failure. This is in a strong trend. Red bars ignored. This was a very bullish green bar. Gap down a little bit, and that was a breakout. That was a very tradable breakout. But then at the close of the day, it negated that with a topping tail. So that says, for those of you who remember Lost in Space, an old TV sitcom, danger, danger. That's the message of this. Danger, danger, the breakout failed. And so if you aren't smart enough to read the messages of this and have a stop loss, I mean, look at this. The thing fell 20 bucks in a couple days. Here's a picture of our W bottom. This was a while ago when Facebook was being investigated by the FTC. Fell 13% in 3 days. And just like I said, the rocket ship will run out of fuel. When things are tanking like this, we just sit back and wait for our bullish patterns because the selling will eventually ease, unless it's like that movie company I showed you. But we don't enter until we see a picture that we recognize. In this one, it's a W bottom. It's this topping tail ignored in a range expansion bar. So that was an incredible day trade long, and also we sold puts there. Couple messages on just these stars that I'm pointing to. This ugly red bar surely suggested lower prices. It didn't, then it gapped up. Bottoming tail's a little retest. This red bar suggested lower prices. This is a 180 reversal. And then what we call a bullish 1, 2, 3 continuation. Look at that. We had 2 bullish inside days in the top range of this. That's a no-brainer long. Just reading the messages of this pullback into the gap, rising 50, 180 reversal. You just, the odds are overwhelming, and you share size it and manage in between. We do a lot of day trading in the green trading room also. This was the spiders. I don't know if this was ahead of FOMC or some type of news on stimulus. That's an ugly, ugly red bar breakdown. The message is lower prices. Now, it's not a 180 reversal because it didn't happen in the following bar. Nevertheless, it didn't go down. After 4 bars, it negated it. Then we had a little pullback, no-brainer entry. And somebody was asking about, what time frames do you want to trade? There you go, no-brainer entry on the 15-minute chart with a price void. And we'll show you those on the fangs here in a minute. This is just bullish price action here, pull back to support. And Greg and I use TC2000 and all of these setups and even just individual bars we can search for. But WRB is our wide range bar, our 180 reversal, our bottoming tail, our gap ups, and then we just scan through these, and this is how we find trading opportunities that we trade ourselves and give to our subscribers. And if you are a customer of ours, then Greg shares these scans with you for free. You just got to get TC2000. The message is here. We're about done. Look, people who don't believe in technical analysis, I just laugh at them. This is building support every single time. This got slammed, slammed, slammed. Buyer stepped up, slammed, buyer stepped up. Red bars ignored. It's right there. The sellers could not take it lower.
But it is in a trading range. That kind of suggests that it should break out.
Yep.
Eventually. Right?
Yep.
Yeah. I guess it did, right? So I see what it is now.
Yeah, exactly. This is just showing you a trend. Greg teaches obviously in his course what is a trend, how do you determine it, what's a trend break, what's a new uptrend, what are attributes, and we can't go over all that now. Again, we could talk an hour on this one chart. But you expect green bars to be ignored. You expect shallow retracements. Bearish pattern there. This is a swing trading course I've been referencing of Greg's. I don't care if you're new to trading or have been trading over 20 years. It's an amazing course. He puts it together in these thought building modules. So once you're done with the course, you have all of the concepts that are the master trader method of interpreting compelling patterns and trading using technical analysis.
Let me answer Vanessa's question. She says, how do you avoid the trap to be? How do you avoid trap to be bearish? In last chart, it went up. Is this was the chart, Dan?
I don't know.
Maybe the prior one.
Yeah, yeah, Vanessa, just tell me which one.
I don't know if she can tell you, but
Well, up or down. This one, okay.
well, there's no, for something to be a trap per se, it has to trigger a trade. So just because there's a big red bar, that doesn't mean that we're going to trade it. There has to be a trigger. It has to trade below a prior bar's low, and just being a big wide range bar, that's not going to trigger a trade. Not necessarily, not we have to get into money management for doing that and explain patterns in greater detail. But like a 1, 2, 3 continuation pattern incorporates a wide range bar and then an inside bar. And so there always has to be that trigger. And so what you're saying is, how do I avoid failed trades? Well, you can't totally, right? We're odds traders. We're putting the odds in our favor. So you have to have a part of your trade that says, well, this is a starting point to my interpretation. We talked about the patterns, we talked about voids, we talked about multiple time frames, and you have to talk about, well, what's going to trigger that trade as well. And then at some point, possibly, right, we know what's going to happen at some point, that a trade is going to fail. So money management, we take calculated risks and losses at times. And that's what trading is about.
Yep. And for you option traders, Spiders has multiple expirations during the week of when they expire. And this is our favorite to sell credit spreads on zero DTE means they expire that day. And every one of these stars would have been great zero DTE put spreads. And that brings me to the last chart here. I mentioned selling bull and bear credit spreads. You can go to mastertrader.com/spread trader if you want to see our seminars on how to learn that. And then the green room I mentioned, we throw in 3 months of the green room, and the weekly options trader specializes in selling these credit spreads that expire 10 days or less.
No, Balas, I'm saying your name right. I don't use VWAP. I'm of the opinion all indicators are worthless and misleading. You just need to look to the left. Where's support and resistance? To look at a volume weighted VWAP, volume weighted, whatever it is, price weighted, the name. It's going to show you a line that's in alignment with there's some congestion to the left. So, just learn to read the price action, remove the spaghetti screen from your chart or the bottom of the chart with all the indicators, follow bar by bar candle language as we're speaking about here. And like for me, many, many years ago, clarity will come to what you're doing here rather than, putting the cart before the horse, meaning you want some indicator to tell you what to do versus looking at what is actually moving. It just doesn't make any sense. Same thing with drawing trend lines and Fibonacci lines and Elliott waves, and all of this stuff is just a black hole. So keep it simple, stupid.
Yep.
Yeah. We do look at pre-market data, so especially if something's active. Yes. So. All right, Dan, look at a few live charts.
Yep.
We got some time?
Yes, we do. 10 minutes. Yeah, let's look at the broader market. I'm seeing signs again. Today's theme, the messages of the candles. I'm seeing slowing momentum and reversals right now. It's 12:50 Eastern. Had a very bullish morning. So if you're a day trader, there's definite signs of this. Looks like maybe the high for the lunch period.
Yeah. So there's the market charts. This is one of the screens that we look at on a 5-minute chart throughout the trading day in the green room with other traders. As you can see, the Russell is showing relative weakness today. At the beginning of the week, it was the one blasting off, showing relative strength. Now it's reversed, showing relative weakness. And what Dan is speaking about here, you can see the S&P 500. You got a wide range bar breaking out to a new high on the day. And then the shock, it broke down below all of these bars. And why Dan says the high of the day or for the morning anyway is in. It's logical, right? You get that kind of a shock and a big down move like that, that's going to scare the hell out of buyers. And they're going to say, hey, let's move on and either take the money and see what happens a little later in the day. And the NASDAQ, which has been stronger, it's not as obvious, like this kind of a breakout and failure, as it was kind of plodding its way up. But one of the things to point out, and I don't remember which slide it was that Dan was showing, but what you see here, I can get my, is see how this started the move and there was power. And then it was a little slower. The momentum slowed and it came down to the support to the left. And then you got this more of an accelerated type of a move, into, the time of day where things would typically stall. But this accelerated part of the move was a heads up that is probably likely to stall. And there's your wide range bar. And the way it broke down under those bars, it still hasn't violated the trend. So let's come back at, 2:30 or so. That's what we typically do. You come back around 2:30 or so, and we'll see what this does as far as wiggling around. We'll take note, So here's where it started the move. And if it's all the way down here, it may be where it tries to advance again. Or, of course, it could just go sideways. We don't know what it's going to do. But right now, it's moving up. And the Russell here, which has been the weaker, that looks like it's going down to the low of the day. So from there, we could start looking at, what's happening in higher time frames and develop a bias from there. But you guys want to look at a few individual stocks? We're happy to do that.
Yeah, just tell us the symbol and the time frame if you want.
Terry's asking me, why do I use NinjaTrader and eSignal? Isn't one enough? It could be. One could be enough. So part of the reason is I've used both of them probably for 20 plus years. Many years ago when I used to just trade stocks, after the bear market of 2000, stocks were decimated and they really didn't move anymore. Decimalization, they were all single digits. I started trading futures, and I did that from I bought a lifetime license to NinjaTrader, and that's an awesome platform for trading futures. So I still use it to this day, and I use eSignal for stocks. But I could use eSignal for futures as well. Okay.
All right, we got Delta, Rad, MOH.
MOH, Molina.
Yep.
Why does my chart look like that? This might be ready to go up again, Dan. Clearly it broke down.
And the put spread candidate.
Yeah, it broke down here. Look at the little breakdown there, and notice this little bottoming candle there. So it's at the top of the range right now. And tomorrow's our last day of trading. I would love for this to stay here tomorrow,
Right.
Because it went from the bottom of the range to the top of the range. And then next week, look for it to go higher. So we just need to see what it's going to do at the top of the range here. Aaron's asking me, let's give YouTube a shot here. INO, this was when you were trading, or I know commented on, Dan, yesterday.
Or maybe a gap breakout. Yeah, the gap breakout is when we were trading it
Here,
last week. Yeah.
yeah. And
Yeah.
now it's falling back. Biotech. This is why at the beginning of, before we started MT Live, someone asked me about a particular stock. And I said, it looks great, like it could go higher. I said, but it's a biotech, which comes with risk. And this is what biotechs do. You know, some of them, you know, they can double in no time and they can lose half of their value in no time.
Yeah.
They come with that risk.
All right. Yeah, you have 10 requests now.
All right, so let me speed it up. Square looks great. You know, it was consolidating. It looked like it would go lower, but you know, today the markets came out of the blocks, and you know, so now it's at new all-time highs. I would think $120. Wide range bar igniting out of a base. Merck, kind of messy. I don't like it. Bottom of the range, top of the range. It could keep going. It's got the void. You know, so look at the hourly chart. You can see what I mean by that, how clear it is, how it came down so hard sideways and now at the top of the range, but it could keep going. So keep that in mind. Valid power. That triggered today, Dan.
Yeah. Yeah, we bought the stock because of
Yeah, 1, 2, 3. Continue 1, 2, 3 continuation pattern. New all-time highs. That triggered just before we came on here. Boeing or Costco. Kind of messy. It's got a void above. I'd wait maybe till tomorrow. See if it closes like that. It's only 1 o'clock or almost 1 o'clock. That may not look like that at the end of the day.
And then I said Costco put spread idea.
Yeah, if there's premium.
Yeah.
Lad looks good.
Yeah.
Yeah.
It looks great. LED.
Not extended.
And
It's got resistance over here, so keep that in mind. And $160 will be a stall.
Boeing's actually a good one to discuss, Greg. Discuss the 3 daily bars today and 2 days ago. So,
That's crazy.
yeah.
You know what? Nice move up. And so for a 1, 2, 3, this is supposed to stay up here and then keep going. You know, the big gap down creates a lot of uncertainty. You know, it was holding up today. I don't know what to do with this.
Yeah.
You know, I mean, if it closes like this and breaks under these lows here, that's going to be a problem next week, but it's got support, you know, right there. So for me, I wouldn't want to trade the short side. I'd rather keep an eye on it, and I'll set an alert. Duplicate that. I'm going to set an alert up here because if it should turn around, that is going to be a good long. So we'll keep an eye on it.
Yes.
CX.
Yeah. This Maxer is, I'm going to keep it on my list. It looks good.
This could be a short. If it closes like this, Terry, could be a short candidate. It was hanging down here and it came back up. So yeah, if it looks like that at the end of the day, and for sure if it breaks below here, it should go a lot lower. And 1 or 2 more. I want to ask you about SPX. I don't know what this is going to do. If it breaks below here, it should go lower. So it's showing relative weakness compared to a lot of other things that had this pattern coming into the week. And now you got this red day today. So I'd be careful with that. SPX.
Now, Greg, you meant WPM.
Oh, WPM.
For Trevor.
Set an alert here. Maybe tomorrow it triggers and it'll go. You know, so you got the bottoming tail bar here. But, you know, sideways, up. Buyers on pullback. wide range bar, consolidation today, obviously showing relative weakness. But maybe, you know, tomorrow, the day before the holiday, the market keeps going. So I'm going to send an alert there.
And Cameron's SFIX looks, it's in a trading range, but it's a bullish, it's acting very well too.
Right. But bottom of the range, top of the range. This is a breakout that could fail. Maybe not fail completely, but could come right back in your face again because it's at the top of the range and then breaking out versus doing some sideways price action there. I don't like it. It's top of the range, bottom of the range.
Yep.
And let's look at SPX. Someone asked me here. 15-minute chart they're actually asking. So look at that. That came back, Dan. No, that was looking at a 5-minute chart I was looking at. So the momentum is slowed down. It's into close to this gap fill there. So they're asking about 0 data expiration. If there's premium up here at 3160, go for it. I don't know if there is.
I'm sure there is in the SPX, not SPY.
SP500. Why is it showing me these strikes, Dan?
Only a dime? Forget it. It's not worth the risk.
There we go. Oh, okay. It's not opened up enough. I'm not seeing the prices. Something's wrong here. The strikes. There we go. So 3160. No juice. 3140.
Yeah.
Market strong.
It's not.
I would wait.
It's not worth it.
With SPX, these with any spread, is the time factor, especially with these. So you might say, well, I was thinking, well, if it comes down here, right, 3140 will be attractive, but you're not going to have this premium there anymore. So even if it's half of that, maybe it'll make sense. You could do more contracts. Maybe it makes sense at that point because you'll only have a few hours so to expiration. So it's something you have to consider and weigh as to, you know, the probability of going somewhere, because as time goes on, those premiums are going to begin to shrink. So with that being said, Dan, I think we are a wrap here.
Sounds good. Hope everyone enjoyed them.
Yeah. And everybody have a great holiday. Be safe. It's crazy out there. And 4th of July, stay home with the family and a few friends. But all the best. We'll talk next week.
Good trading, everyone. See you soon.
Thank you for listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.